Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the podcast, I have a chance to talk to my friend and collaborator, the fund manager and author Sandy Nairn, who is the lead manager of the Global Opportunities Trust, among others. Sandy, I want to talk to you about a number of things. You are, I think, quite well known as the author of a book called Engines That Move Markets, which is a history of past technology cycles through the ages and what they mean for financial markets and shareholders. A very interesting study that you did about 25 years ago. You're just about to publish a new book, which is about the impact of AI on markets and drawing comparisons with earlier periods. I'd like to come on to that in a moment. That's coming out in the autumn, and I think should be required reading for most investors. But we also want to talk about the markets and how AI is going down and how your trust, the Global Opportunities Trust, is navigating these interesting times at the moment. And there's also some interesting research we might discuss as well that some purist investors will be interested in. So let's kick off by talking about AI and the markets in broad terms. Now, one of the many conclusions from your earlier study was that advances in new technologies are often associated with periods of excess in financial markets, periods of enthusiasm followed by periods of bust. That's well chronicled. So, just in very broad terms, where do you think we are in the AI cycle and why is it become such a dominant feature of investment market thinking at the moment?
So let me, just for those who aren't familiar with the cycle that we talked about, and it's not a mini cycle, there's bigger things going on, but let me just talk to it. If you've got some kind of transformative technology, almost by definition, you start off with the concept and the feasibility. And if you're going to raise capital for it, you have to get into the promotional phase. So you have to make all sorts of claims about what it can do. And these are technologies that are underpinned by science. It's not made up, but it's some distance from commerciality. So you're in this promotional phase. And then as you gain attention and you show proof of concept, they often then tip over to mania might be too strong, but you've managed to persuade the world and it's full of believers that it's transformative. And if this coincides where there are periods of significant liquidity, then you tend to get inflated share prices. And there's two elements to that. Because it's extremely difficult to pick out the winners, if you're looking at companies, you'll find that all sorts of companies have very high valuations, and you know that there's a very high mortality rate even with a new technology. And that's the mortality rate on the companies creating the new technology. There's also, as will come as a side effect, the mortality of the companies who are going to be replaced by this new technology. That's the first three stages. So, the concept, feasibility, science, second, promotion, third, the inflation of values. The fourth is where, if you like, the rubber hits the road. Having made all these promises or raised expectations, you have to deliver against them. And the fourth phase is really the shakeout phase. So it's, tangibly, are you making profits? Can you sustain yourself? And then the final stage is where you get to maturity and you've got the people that are left. I think we're in the fourth stage just now. People are beginning to look critically at how long do we go before profits. I'm here just talking about one segment, which is the one most people are focused on, which is generative AI. And there's other things we can get to. We've seen SpaceX and underpinning that, a very good satellite technology business, but the Gen AI business that sits within it. We've had the discussion and the rumors about OpenAI and how it's getting on, and Anthropic and their valuations. And then we had a whole bunch of discussions about the infrastructure that surrounds them and the extent to which capital's getting burned because the revenues don't sustain the models at the moment at this phase. So I think we've entered the shakeout phase where you're going to have to start delivering against your forecasts. And here's the other thing that's important. When you have IPOs, you have to deliver forecasts. when you're still private, you have to deliver to your private investors, but the general public has to try and piece together the jigsaw of what revenues are. And you get some idea because the companies are trying to promote themselves without explicitly giving forecasts. But we're at the stage now where you have to start delivering against them. And investors are going to be looking for the winners and looking for the losers. And I think that's where the shakeout comes.
Right. So, in effect, many are called, but not all are chosen when they get to market in particular, and when their sort of full life cycle is observed. And as you say, we're probably in stage 4 now. I mean, one can already sense quite a significant degree of promotion has gone into the discussion of AI, should we say, in its many manifest forms. But I think one key point we have to establish is artificial intelligence has been a dream of people for many, many years, going back 30, 40, even 50 years. But your view, I think, is that we finally arrived at least one version of the technology which is genuinely transformational and therefore can be rightly lumped with other generational transformative technologies. Is that right?
Yes. So I think the starting point here is that there's two views that it's perfectly reasonable and rational to hold simultaneously. You can be in a period with excess valuation. That doesn't negate the importance of the technology. That's just part of the capital cycle. And I would potentially go as far as to say as the potential for this technology is not hyped, it may actually be underestimated. And the reason I say that is that I don't view this as a technology where you go, like we have electricity, we have the internet, I view this as the equivalent of the whole period of industrialization just starting. So my parallel is when James Watt tripled the efficiency of the steam engine. That enabled the three things that were necessary: the power to do things. The raw materials were available in the sense for the time of the British Empire, but you had all the raw materials, and then you developed the machines and the engines that could take advantage. And then you went on 150 years of successive technology cycles. So the steam engine, electricity, electric light, all of those. My view on the AI is the equivalent to all of these in a single go, because the three things that have come together, and the most important being power, started with the semiconductor and then went to parallel processing. The raw materials, which are the data, were available because the internet caused digitization. And then the tools, the engines, if you like, all the algorithms were able to be employed because you had the power to use them. The big parallel is between the start of industrialization and now, and the generative AI and its potential uses is a bit like, and you've got to be careful not to stretch analogies too far, but you started off with a static steam engine that effectively pumped water out of mines. And then as it got refined and more refined, you could use it for transportation. Then you could use it for generating electricity. And so one thing followed from another. And I think we're just in the foothills of this at the moment. And whilst the market focus is very much on 2-bit generative AI, the kind of retail element where we go in and it writes my essay for me, or the replacement of coders in the agentic AI, its uses go way, way, way beyond that and will evolve and emerge in the next 20, 30 years.
In ways that we probably can't yet predict precisely, because they will depend on many other factors.
Yeah, I mean, the prediction piece is interesting. As part of doing some of the previous research, you went back and looked at predictions made by people who really knew what they're talking about. And what you found was that the predictions were pretty good and pretty accurate as long as the progress or evolution was linear or close to linear. It was when you had some non-linear event came in that it all went to pieces, or some new discovery. So Thomas Edison, if you look, he did some interviews and so forth where he predicted the future, and a lot of it was very accurate. And some of it was completely and utterly wrong. But then he wasn't able to foresee some of these things that were happening. And I think the same now. So there'll be a lot of pretty accurate forecasts on the linear extrapolation of what you can do with generative AI. But there's a range of other things lurking out there, not least nuclear fusion and quantum computing, that would change the trajectory of it all. But even without bringing them in, there's a long extrapolation of what we can do. And you're right, even within that, there'll be people in specific occupations with specialities who couldn't do things who now can. We can think of a lot of them, but we won't think of all of them.
People talk about the point at which we reach genuine artificial general intelligence, or the next stage, super intelligence, and variants such as agentic AI, as you mentioned, where these AI tools actually go on and do things for you independently rather than for yourself. Is it worth even talking about that? I mean, the point at which we reach artificial general intelligence is a philosophical question, I think. Does it actually matter when it happens, or indeed whether it happens at all? What's your thoughts around that?
Yeah, I mean, I almost lost the will to live reading books in philosophy, and you get into all sorts of philosophical points when you talk about general intelligence and superintelligence and definitions of what those things are. And I think we're some considerable distance away from that. On the other hand, in specific areas and arenas, the power of AI is enormous. The agentic thing is much closer and is already happening, and it will be on specific tasks. And I think there's a few things there. I think the key on agentic AI is the domain expertise that goes with it. Because if you're going to effectively create products, you need to know what the customer wants. AI and Gen AI can help you deliver something that takes you to a conclusion, but you have to know what the conclusion is. And I think there's a bit of a mistake sometimes of assuming that AI will do all that for you. I think that there's a methodology or a structure that suggests where agentic AI is going to come first. And where it's going to come first, I use the example that I've mentioned to you before of chess. Chess is a well-defined game. There's a case history of it. It has significant computational requirements, but they've been overcome. But it's a well-bounded task, and hence AI can beat most people at chess pretty much all of the time. But if it's simply done by machine learning, you'll find that AI will cheat. And the reason for that is that, and this gets to your slightly the dangers of the philosophical point. And it was explained to me that one way of thinking about AI is just think massive repeating matrix algebra. And that works its way through the data to narrow down conclusions. And you can take Alan Turing's definition of intelligence, or you can go down the philosophical route. Alan Turing's, I think, is easier to work with. And it basically just says, if you can't tell if this is a machine or not, and he has the imitation game, which was an example he used to explain it. And if you can't tell that it's not a human, then it's intelligent. And that's a very fair, pragmatic definition. But it doesn't take you quite as far as you need, because in the agentic AI, you get into issues, as the name suggests, of agency. If you're going to give matrix algebra the power to do things, where do the boundaries sit around it? And that runs from important to absolutely critical, because if agentic AI could be making decisions that affect life and death, for example, or even things less than that, you need to be extremely careful about it.
Indeed, you do. And that will be true even in the cases that are given a lot of attention, things like drug development and analyzing proteins and things, and being able to construct things that human beings can't really do yet. And that could be a positive, but you still don't know whether it's right or not when you get to the end.
I'm probably less concerned about that, because speaking to old colleagues who are in that field, what protein folding is doing is compressing the grunt work they have to do before they do the discovery work. And I think a lot of AI will be that. The stuff that's not necessarily dull and boring, but it's not hugely innovative, bring the better set, more compressed set of information to allow you to explore and accelerate what you're doing. I think if you're allowed, but I don't think it could, for it to actually produce drugs and short circuit all the testing. I mean, the most obvious one is the armed forces. If to get speed of reaction, you allow agentic AI to control the direction, targeting, and firing of weapons, you couldn't get more dangerous than that, or an area have to be more suspect. But there's also other things like, and there's example already seen, and I'm sure everybody now looking for a job is concerned that AI is sifting the applications, and so you have to try and figure out what AI is going to sift. And what AI does is it reflects the biases of the data on which it was built. So if you've got embedded biases, then they're going to reflect themselves. And but some of it is, really obvious, like armaments and firing systems. Other bits of it are probably as obvious, but not understood to be quite as difficult and dangerous, because we've seen it in sentencing in the US of trying to assist in a natural way to deal with reoffending rates, but finding the data biases will give certain categories higher sentences than others. I mean, it could be quite pernicious, so lots of care needs to be taken.
So there are plenty of risks out there around the development of AI, and of course the development of AI is going at a very rapid pace, as we know, and so the whole issue of safety and guardrails and so on is still up for grabs. But I guess as investors at the moment, the priority is elsewhere. I don't think financial markets are much concerned with the risks inherent in AI at this stage until something disastrous happens and it might blow the whole thing up as a development. But if we just talk about what's going on there, so we know there's been very strong performance by what we know as the hyperscalers. These are the companies that are developing the models that are driving AI effectively. And more recently, we've seen a lot of excitement around some of the chips and memory chips that are needed in order to make all this happen and the computing power that's needed. So is this a kind of typical example we're seeing of how markets react to what is in the short term a very rapid growth story? But we don't yet know who the winners are, and the market is constantly trying to guess who the winners are, who the losers are, and reacting to whether the prices are excessive or not. Is that a fair summary of what's going on there?
So yes, I mean, I think if you like the London Underground, mind the gap is the thing that comes into my mind. You can't do AI without infrastructure, therefore you've got to build the infrastructure. But until you build the infrastructure, you can't generate sufficient revenues to pay for it. And the question becomes the magnitude of what is being spent building out this infrastructure. How long is it going to take the revenues to come? And what kind of nature of profitability would you expect as you run through the different levels of the different operators? Now, naturally, at the moment, a bit like when the internet came, it was the builders of the infrastructure that made the profits to begin with. And then actually they found themselves, well, they were utilities and you got utility type returns. So at least one letter of the PMP didn't do very well eventually. So if you look at the profits and the profit margins of like NVIDIA, the dominant player, it's hard for me to see that those profit margins are sustainable. They're way above historically what has ever been recorded. But they can be sustained for a while because rightly the rush to get the infrastructure is in place. But you're also going to find highly likely that, as you're again already seeing, more and more different types of chips coming out for specific tasks. And because you mentioned chip last, the production of chips is a design function, and the chip fabrication companies, you've seen Google designs its own chips and lots of other people are doing it because they don't want to pay the premium. And you'll continue to see the chips get better and better, and you'll see the languages, the way inference is done, I think, is likely to continue to improve. So some of those costs potentially will fall, which is good in the long run. But the profit margins that people are managing to attain at the moment are, in my mind, likely to fall with them, which is good for all of us because it's not healthy to have that level of profitability and the kind of monopolistic nature of it. And the monopolistic question will also feature. So typically when you build infrastructure with this degree of rapidity, you overbuild and then you have the rationalization phase of it. There are so many uses for generative AI. You can probably use up the compute. Whether you can use up profitably is the question. If you give something away, you'll get lots of people using it. OpenAI, a while ago, it was 5% were paying customers. But what you can see is the price of tokens. This is becoming a live question. So the mind the gap point is really, in my mind, we're going to get a period where those using the compute don't have enough revenues to pay for it. At the moment, the capital is being burnt to do it, which is naturally what would happen. It's how long people will be willing to give that capital and at what valuation when you're still not sure who the exact winners are and whether that causes the shakeout in valuations. And I think there's a pretty reasonable probability of that happening.
So at the moment, I'm probably simplifying here, but everybody's trying AI out, particularly businesses trying AI out, as well as private individuals trying AI out, and they're having a lot of fun. But they haven't yet discovered whether it's actually really useful to them or whether they actually are going to end up wanting to pay for it. Is that right?
Well, it is, but just to widen things a little bit, I'm involved with a small language model company. I pick their brains, their knowledge and information because they're at the cutting edge of a lot of this. And if you speak to them, if they're using large language models initially, they largely don't care whose it is. It's who's the best and who's the cheapest. But the product that they are selling successfully, but it's only just emerging, uses 99% less compute. And it's very specifically targeted. And if there's one of them here, there's loads of these companies, some of which we know about, some of which I wouldn't know about, who are developing cost-effective solutions. So it would be a mistake to think of AI only as large language models and the hyperscalers. There's lots of other businesses going to emerge, which will be hugely significant in terms of depending what the product is, improving service levels or reducing costs. And they're just going to keep emerging. The market focus naturally is on the huge players and the IPOs that are coming. And it seems to me it's going to be quite hard to make money, because if you look at the companies that are in private ownership, they've stayed in private ownership way, way, way longer than they would have historically. That's been growing for the past 25 years. So how much value is left for the public investors coming in? They have to go public because the private investors don't have enough money to keep funding the revenue gap. So for me, I think that technology is a transformation in our lifetime we've not seen before. There's going to be huge opportunities out of it, but it's still got to navigate that one part of it, and the capital markets still have to navigate that gap.
And I guess one reason they have stayed private longer is because the companies who are developing them in the main, well, there's two different types. There's obviously companies which already have a lot of cash flow from other things they're doing, and we're talking the likes of Amazon and so on, or they are like OpenAI and Anthropic, they are newcomers being funded from the start. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. So the OpenAI and Anthropic IPOs, you say they're coming. They're in a race to decide who's going to be worth more at the moment. Would it be totally cynical of me to think that when they do come to market, they will probably be at the kind of peak moment of the hype, if you like, and that we wouldn't be at all surprised if they did do what SpaceX has done and then take a dive for a while afterwards until the market's really worked out what is going on and whether they're really worth what they've been presented to the public as?
Yeah, I mean, that's what has the historic precedent. You know, you sort of imply normally what happens. And then you mentioned the funding. Yes, they've been heavily funded by very smart private investors. You know, and the difficulty for people in public markets is the private investors have access to a lot more of information about what's happening than you do if you're simply on the outside. But they've also been, and many people have written about this, and I know, you know, Edward Chancellor's written about it and others, there's a significant element of vendor financing going on. And that's not unnatural either. So NVIDIA's been funding a lot of purchases of its own chips, and Microsoft did a deal with OpenAI where they gave them lots of credit for their cloud services. So the whole complex is very heavily interlinked. And there's nothing nefarious about that. These are all logical, rational decisions. But what it means is if something goes wrong in the system, it ripples pretty quickly.
Yeah, so there could be significant fallout if that happens at one point and it runs right through the chain. That could be a nasty market period for sure. But in terms of the others, I mean, what you're saying is, well, already people are talking about investing in the picks and shovels, in other words, in the things like the chips and electricity generation, for example, which is, if the compute demand keeps on growing at this rate, you're going to need an awful lot of electricity. So there are many ways to play this. And I imagine that over time, that will broaden out as new companies emerge or existing companies turn out to be AI winners who nobody thought they would be. But is it net, you think, typically going to be associated with a strong market period or a poor market period? And in particular, I mean, one of the points you make in your study of past cycles is that it's very important that you have a lot of liquidity, as you mentioned earlier. And quite often interest rates are quite low during these periods when you get the excessive market valuations. Obviously, at the moment, that's not happening. Interest rates are going up, or at least long-term bond yields are going up for mainly other reasons, I think, because of government deficit funding requirements. So is that going to put some sort of brake on what happens, do you think, before we get to the absolute peak of excitement, if you like, or even euphoria in the equity markets at least?
Yes, absolutely. I mean, the public sector has been on a non-sustainable path. And if you like, it's sustainable as long as there's confidence. And when rates start going up, that suggests that confidence is beginning to drift away a little bit. And these things, as you know, can turn very quickly. And so whilst economic growth has been strong in the US, a significant component of that has actually been all this infrastructure build. So I put all those things together, and I would be, whilst very excited in the long run, really quite concerned in the short run. Doesn't mean you can't find equities to invest in, but you want to be particularly careful about what you're paying for them at the moment and the sustainability of their margins.
Well, that brings us back in a way to talking about the trust of which you're the lead manager, Global Opportunities Trust, which you manage with Goodhart Partners now. This trust has been around since 2003. You founded it and continue to be involved in it, have significant investment in it yourself. You had a bit of a kind of strategic overhaul, I think 2 or 3 years ago, which is now bearing fruit in various changes. And this trust now sits in the flexible investment sector. Can you tell us what the trust is really about now? What are you trying to achieve? And we'll come back to whether or not AI features in that at all in a moment.
So in its simplest terms, what we're trying to do is, you talked about the concerns about market valuations and, we don't need to participate in anything. What we want to do is generate compounding long-term returns. And whilst we're very negative on a whole bunch of areas, we want to make sure that we can at least deliver some form of returns. And there's enough opportunities in the markets to allow us to do that. So we're looking to kind of gouge out 5, 6, 7, 8% returns, even whilst carrying the liquidity. But we want to make sure that we're protected if the sort of downturn comes that we anticipate, at which point we'd then be able to deploy that liquidity and expand the direct exposure. This has been something we've been thinking about for a long time. And I think what has been created, particularly by Alan Bartlett at Goodhart, is if you think about how you invest, most people, whether they recognize it or not, are temperamentally suited to investing in a particular way. I don't like, and I've never really liked, the terminology of, value growth and quality, because it can hide as much as it reveals. But it's certainly the case that some people are better suited to identifying opportunities of a particular nature. So you can sit and you can say, well, I think there are opportunities in this kind of company or that kind of company, but you may not be the person to actually identify who those companies are. So what Goodhart's been trying to do is bring in people who philosophically think the same way, but their skill sets make them much better at picking companies with high growth profiles, and other people who find that difficult but are better at balance sheets and et cetera, et cetera. So, I won't sort of bore you with it all. So I think what we've got is when the opportunities arise, we'll have the people who've already worked on them, who have a natural affinity with a particular type of company so that we can actually exploit them and buy them. So we're keeping our powder dry whilst trying to get some reasonable returns for investors while doing so, and ready to turn the taps on when the opportunities come, recognizing that you have no ability to predict when that will actually happen. My gut feel is we're not far away from it. And I think some of the rotational volatility you've seen in markets suggests growing uncertainty. And it also suggests increased leverage, which is quite helpful in a negative way. So that's what we're trying to do with the trust is have the people able to exploit the opportunities when they come, and philosophically being ready, willing, and able to do it when they appear.
And the secret sauce behind that is how you construct the portfolio. Is that essentially what it is? You pick the stocks, but you also have to make very sure about their correlations and so on.
Yeah. So, one of the skills that paradoxically is not as strong as it should be, I think, is the understanding. And an area that I was either weak in or should have been stronger, but other people in the team bring that, is understanding not just how things interact today, but how they're likely to interact in the future when conditions changed, so that you can get the correct balance in the portfolio, so that if the market declines rapidly or rises rapidly, and you're correct in that your portfolio is actually properly structured, that it reacts the way you want it to react, because there's thinking things through, which I feel like I've done a decent job in the past, but I've perhaps not done as good a job at implementing as I could have. Again, because it's, what kind of skill sets have you got? How did you develop them? And what I do believe we have at Goodhart now is different people who like working together, but have different skill sets allow this to happen.
So, as I say, you're in the flexible investment sector. You've, over the last 3 years, delivered a share price total return of just over 9%, I think. And that is roughly 5 or 6% real return over time. But your proposition is that you can deliver 5% real returns over the long term, that is after inflation, but with much reduced drawdowns and therefore more persistent risk. In that sense, you're kind of competing against the likes of personal assets and capital gearing. They're slightly more conservative in their targets, I think. But the difference still at the moment is the trust, I don't think, is very high profile. You're sitting on a wider discount than they are. It's come in a bit, but you're sitting on a discount around 15% at the moment, which is particularly odd because you have around 40% in liquid investments at the moment. So the discount on the actual investments is pretty wide, right? So what are you doing to try and bring that discount in? Because if you're able to do that, that will obviously deliver a much enhanced return to shareholders.
I mean, I think you have to kind of think through, well, the risk adjusted numbers I think are very good. So why are we not relevant to anybody? And I think the biggest barrier previously was the size of the trust and its liquidity. People don't want to find they can only sell a wider discount. That's one. Secondly, we needed and still need to continue to communicate what it is we're doing so that potential shareholders know what they're buying. And we've been working very, very hard on that. And then because the wealth market has so concentrated, there's many people probably wouldn't look at the trust, but actually the natural thing to do here is an open-ended counterpart, which makes us relevant to everybody and widens the audience, which should have a very positive effect on the trust itself. But I think the honest truth is, like anything else, if you deliver the numbers, people will come and buy it, so long as there isn't a liquidity barrier or an informational barrier. So bluntly, you try and address the information question, which we have been trying to do. We've been putting shoe leather down, talking to people. There's an open-ended vehicle so that people that write larger tickets can get involved. But fundamentally, underneath all of that is you just try to keep doing the day job and produce the returns, and then eventually it should take care of itself.
Provided you don't get somebody on your tail, of course. And there have been cases of investment trusts that have people on their tails.
No,
no names.
Right. Yeah, no, I mean, it's the shareholder is quite tightly held, which is a positive and a negative. And just to be open, myself and family own a reasonable piece of it because we believe in what we're doing here. But the key point is just keep doing what you're doing. And it's nearly 5 years now since the change in policy, and the numbers look, I think, very good since then. And keep telling people, and if you can't persuade them, then you have to think of different things. But we feel like we're getting a good reception, and the returns are reasonable given the risk profile. The risk adjusted returns are very good.
So the correlation with equity markets generally is low, and the correlation with many other types of global equity funds in particular is low. But just to circle back to the subject of AI, I'm looking down the top 10 holdings. You've only got 24 holdings in the trust. I'm looking down the top 10 and, well, I don't immediately see any things that are obviously AI stocks there. I mean, a couple of names that date back to the last cycle. We've got Orange and we've got Verizon Communication. These are names that go back a long way to the last technology bubble, shall we say. But you've also got things like Unilever, Carlsberg, and so on. I won't ask you to explain them all. So is it safe to say you probably won't be investing in the OpenAI or Anthropic IPOs when they come around?
You look at the valuations, you look at the revenue progression, and this is not suggesting that Anthropic hasn't done a great job. I mean, although it's interesting in Anthropic, the people I speak to would have had Anthropic behind the curve 18 months ago and now ahead of the curve in terms of what it can do. And it's done a remarkable job, but it could just as easily fall behind the curve again. And there's no loyalty. If a different provider can provide the same service cheaper or a better service, then agentic professional users will move. They don't look to me like they're going to come at stressed, discounted valuation, shall we say. We did own Alibaba for a while because we felt it had been hit more than it should have, and it did have a whole bunch of AI related attributes, but when it ran up, it was time to walk away. So if you want to draw an inference from the structure of the portfolio, it tells you how we feel about markets. We still think we can make money, but we don't want to lose sight of the downside protection.
And I think I read that among those bigger names, the average PE on these companies is the highest is around 11, I think, and some of them are below that. So, I mean, these are what in the old days would have been called relatively cheap on valuation terms, these companies. Yeah, but ones presumably aren't fallen angels are going to disappear.
Obviously we wouldn't hold the dots if we didn't think we'd get a reasonable return out of them. They don't have to run exceptionally hard to look attractive. So, I think we're very comfortable with them. And AI and AI related, we've got a number of people that are very knowledgeable on the technology and AI related who run specific funds in that have done very well. We have the people who can do the identification and we have the liquidity to take advantage. That's the thing I sort of mentioned earlier, that if stylistically you get put in a box, it becomes very hard when opportunities arise elsewhere to take advantage. And particularly in companies that are technological high growth potential, they don't stay cheap for that long. So you need to be ready to move when that happens. So I'm sort of excited about the prospects, But for me, they still need to emerge at valuations that I'm comfortable with, despite the fact they're going to have great growth. So I said at a kind of earlier point, there's not a contradiction in being very, very excited about what AI is going to bring and quite cautious about investing in it today.
Indeed, there's not, and that might be a general message about timing with these technological cycles that's well worth exploring. I should say that this book, which is called How AI Will Move Markets, is being published in the autumn, and I should declare I have a mild interest in that, in that I did offer Sandy some help with the drafting of a few words, polishing one or two of his many, many words. So I have to declare an interest there. But it is a very fascinating read. I've certainly learned a lot from it. And so I think we'll leave the discussion of AI at that point. There's plenty more we could talk about, and I'm sure I'll look forward to having another conversation along the same lines in due course. But before we go, I want to add one other little mini topic, which I think people might find of interest, as it happens just to be relevant in this week that we're recording it. And that is, you've also done some research into probably one of the most influential academic papers about stock market investing that's appeared in the last quarter of a century, I think it's fair to say. And that is research produced by a gentleman called Henrik Bessembinder, in which he, at least as it's reported, says the remarkable thing, if you look back through the history of stock market returns, is that only 4% of the companies that have been listed in the US market, I think it is, have created wealth for investors over that entire period. Now, that's how it's often reported, but I think you're going to tell me that that is not actually the case.
Yeah, it isn't. The 4% number is correct, given the arithmetic way that it's calculated, but it's not reflective of anything that would be strictly relevant to a fund manager facing the world. I don't want to spend too much time on it because you have to go through it methodically. So what we did was we recreated all the data, and absolutely 4% comes out of it. But what there has been is significant interpretive drift of that conclusion. So where would you point to? Well, the first thing is it's not a time-weighted return. What it does is it calculates the total dollar amount created in excess of treasury bills compounded up over the period. And then it tries to count the smallest number of companies that would have got you the net amount that would have been created. So a large oil company in the late 1920s would have 100 years, and it's a big company, it would be a big dollar amount. There could have been a small company compounding at twice the rate that wouldn't feature because it's dollar weighted. That's number one. Number two, in the 1960s, the Amex was added to this database. And then in the 1970s, the NASDAQ, these indices have much higher mortality rates. And so that percentage dropped from 40 down to 20 and then 20 down to 3 because the structure of the data on which it was being rated. Now, I could go into a lot of detail about other very important issues. Again, not that there's anything wrong with the arithmetic, nor indeed is there anything wrong with pointing out that returns are skewed.
In other words, there's a tail of things that do very well, and there's a tail of things, or even quite a lot of companies that do not so well.
And there's 30, 40 years of literature, which nobody would read because essentially you have to think about kurtosis and how it all works. And you can understand why that's not going to be everybody's breakfast reading, but it is important. So if you take a conclusion out of the work that returns are skewed, that's an appropriate conclusion to take. If you take the conclusion that 4% is a meaningful number, I don't think that is the interpretation. Even with the issues, and again, it's not that what he's done is wrong, it's the interpretation that's put on it, but even if you do the dollar weighted piece, but applied it to a rolling S&P, because the problem is when companies die, they stay in the denominator. So even if nothing happened, concentration would appear to increase. If you did it in the S&P, the number would be 20% plus. So it's just great care in interpreting numbers. And I think that's always the case. When you do analysis and you have a single striking number, it tends to get quoted a lot, but it's not representative of the world we face. The skewness, and it's interesting that the people in the industry that look at it, if I was an index investor, I would draw the conclusion that you have to buy an index fund because you can't afford to miss out on the big wealth creators. If I was an active stock picker, I would say, no. You just need to focus on finding these. So you've got two diametrically opposed conclusions that come from the same structure, and you kind of pays your money and takes your chance. It's just that, the 4% is too extreme taken as a number. That's not what we're looking at. And the second piece of it is the attention you want to pay to the losers, the long tail of losers, should be just as much as you pay to the shorter tail of winners.
Yes, and certainly the conclusion you shouldn't draw from it is that, as you've said, as some growth investors might do, is that well, there's no point investing in most of the market. You really got to go hunting for the big ones, the big beasts, because, of course, that 4%, but that 4% doesn't ever exist at any point in time. It only emerges with hindsight, and at any one point in time, there will be a different number on that available.
And, more to it, it also depends when you stop the clock for your analysis. So if you stopped your clock in the mid-late 70s, the likes of Eastman Kodak would feature, because it part of the Nifty 50. Xerox would feature, and Xerox was a technological leader, but by the end of the period, at least one of those was a negative contributor. So wherever you stop the clock, by definition, the ones that have recently done well will appear big winners. But there's a life cycle in companies. The more you look at it, the more careful you need to be. But that still doesn't negate the point that returns are skewed.
Yeah. So I guess beware of simple heuristics or simple lessons drawn from complicated research without actually looking more into the statistical underpinning. Well, if that's your thing, then you have to read it. And fortunately, you can do so if you want to. This bit of research that Sandy worked on with some academics.
Yeah, if you don't mind, I should just mention that there were two gentlemen academics at Strathclyde, Jonathan Fletcher and Michael O'Connell, and Michael did all the grunt work on it. So I was involved, but a lot of the labour was done by them.
Yes, and you can find reference to that, and you can find Sandy talking about in more detail about those findings if you go to YouTube and look for the Library of Mistakes channel. I wouldn't say be everybody's cup of tea, but if you're into that sort of thing and you love a bit of stock market analysis and history, that's the place to go. So that brings us to the end of this, I think, fascinating discussion. So I'd like to thank you, Sandy, for taking part. That was Sandy Nairn, the lead manager of the Global Opportunities Trust and author of this coming book, How AI Will Move Markets, coming out in the autumn, published by Pan Macmillan, and you can find your way to it if you're interested, of course, on the internet, using AI if you so wish to get there.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.